Hi, welcome to Digging into China. I'm Dong Sheng. On August 21st, the Wall Street Journal published a report titled, "China says, please stop buying our bonds." The article reads, China is experiencing a bull market, but Beijing doesn't seem to like it. While stock and housing markets languish in China, one asset has stood out: Chinese government bonds. Yields on 10-year government bonds have dropped to around 2.18% from around 2.6% a year earlier. In most countries, especially those experiencing an alarming slowdown like China, that would be welcome. Yet, the authorities have gone to extraordinary lengths to try to stem the rally in the bonds they issue. While it is common for central banks around the globe to meddle in their bond market, it is rarer for them to intervene to push yields up. China's central bank just cut its short-term interest rate in July. Beijing's heavy-handed efforts to push bond yields in the opposite direction are another worrying sign about its economy. There were indeed signs of a speculative frenzy in Chinese government bonds. Trading volume had surged and some price actions was getting irrational. One 30-year government bond issued in May traded up 25% on the first day, not a swing one would expect to see in a boring government bond market. But there also are very strong fundamental reasons why investors are flocking to the low-yielding but basically risk-free assets. First, China's economy remains mired in weakness, being dragged down by the implosion of its housing market. Instead of worrying about inflation, downward pressure in prices is the problem. Instead, Chinese core consumer price index, which excludes food and energy, rose only 0.4% year-on-year in July, down from 0.6% in June. And there is a lack of promising investment options. China's CSI 300 index, which tracks the biggest stocks listed in Shanghai and Shenzhen, is down 3% this year after 3 consecutive years of losses. The property market, which used to be the most popular form of investment for Chinese households, remains in the doldrums. New home prices in 70 major cities dropped 5.3% in July from a year earlier. What Beijing might be most worried about isn't the low bond yields, but what they say about China's economy, that instead of lending money out, banks are happier to let it sit in government bonds with ever lower yields. In a country that can stamp out unpleasant news such as economic pessimism in the news media and the internet, bond yields are a sign of trouble that cannot be censored. This passage highlights an unusual situation involving Chinese banks, most of which are state-owned. Despite being government-backed, these banks don't have much confidence in the Chinese economy right now. They see lending as too risky, with potential losses, so they prefer to buy government bonds instead. The Chinese Communist Party, however, wants banks to lend more to the real economy. But the banks are hesitant, given the unresolved real estate and local government debt crisis, which they believe make lending even riskier. This has led to a strange scenario. The Chinese government is issuing a lot of government bonds, but isn't pleased that the state-owned banks are the ones buying them. If the government doesn't want certain buyers for its bonds, one might question why it's issuing them at all. The reality is that the CCP is in need of funds. Ideally, they want these bonds to be bought by ordinary citizens. The government hopes that by getting people to buy bonds instead of saving, it can deplete their savings and make them more compliant with government policies. However, before these ordinary citizens could be drawn in, the banks have already scooped up the bonds. Let's delve into the power struggle between the Chinese Communist Party and the state-owned banks over government bonds. I believe that the People's Bank of China, PBOC, is currently the only bearish force in the government bond market. Yet it still cannot outmaneuver the bullish players. In July, the PBOC tried to push the bulls out by borrowing government bonds and threatening to sell them, which briefly succeeded. However, the bulls circled back and resumed buying government bonds, making it impossible to keep them at bay. Consequently, Chinese government bond yields are bound to keep falling, an inevitable result of the country's economic downturn. However, because the top decision-making body in China, led by our Emperor Xi Jinping and his team of advisors who prioritize appearances above all else, the People's Bank of China is now compelled to support government bond yields to uphold the narrative of a strong Chinese economy and preserve Emperor Xi's image. Previously, the PBOC still cared about maintaining some credibility, so it mostly resorted to bluffing the market, borrowing government bonds and threatening the bullish players like holding up a bomb and warning, "If you keep buying bonds, I'll drop it." Lately, the PBOC has abandoned all pretense and decided to append the game. The central bank started by publicly reprimanding 4 rural commercial banks in Jiangsu for illegally speculating on government bonds, suspending their trading accounts to set an example, essentially warning others that continued speculation should lead to license revocation. Additionally, the Chinese Securities Regulatory Commission has been dragging its feet on approving bond funds and has imposed restrictions on their investment durations, ensuring that bond fund yields don't increase, all to relieve some of the pressure on the PBOC. Despite the PBOC's effort to intimidate through warnings, account freezes, the bulls remain unshaken. The Chinese government bond market has become incredibly dramatic, almost like a soap opera. It's a captivating spectacle featuring not just the conflicts between the public and officials, but also intense power struggles within state-owned enterprises. Let's review the main players in China's government bond futures market. They primarily consist of financial institutions like insurance companies, fund companies, banks, and brokerage firms. Banks, in particular, hold the largest positions in government bonds. State-owned banks specifically act as double agents. They buy government bonds and make profits when there is no directive from the central bank. But when the central bank issues warnings, they quickly comply by selling bonds to drive up yields. This makes them a classic example of playing both sides. This year has seen an intriguing development. Many small domestic banks have started aggressively buying government bonds. The reason? With the overall economic climate being so challenging, these banks are struggling to turn a profit. They are trying to compensate by trading government bonds. This is why, just a few days ago, the central bank criticized the 4 rural commercial banks in Jiangsu for breaching regulations by speculating on government bonds and engaging in improper profit transfers, and subsequently froze their trading accounts. Are these violations truly violations? Yes, they are. They are definitely breaches of regulations. However, the underlying motive seems to be recovering some lost profits. Traditional lending is no longer lucrative, as it's evident that bond yields are on a downward trend. With China's economy expected to keep declining and the central bank unable to tighten policy and only able to ease it, bond yields won't increase. In this environment, trading bond futures becomes a profitable alternative. I suspect the rural commercial banks in Jiangsu that were criticized became aggressive in their profit seeking, leading them to cross regulatory boundaries. What drives this mindset? Typically, when banks deliberately breach regulations, they do so with a calculated risk. For example, if they earn 100 million yuan and face a 20 million yuan fine, they still come out with a net gain of 80 million yuan. To them, risking a regulatory breach might seem preferable to the alternative of going bankrupt or shutting down. This situation reveals that small banks are grappling with a severe survival crisis. Even in Jiangsu, an economically strong region, rural commercial banks are taking risks to stay afloat. This implies that the banks in other regions might be facing even more severe difficulties. How the central bank handles these penalties will be a critical test for its policies. Why? What is the central bank's fundamental goal in economic regulation? It is to avoid systemic financial risks. Therefore, if the central bank imposes severe penalties or bans further government bond speculation, it could hasten the collapse of these small banks. While banks can go bankrupt, the bad debts still need to be covered. This burden either falls on larger banks, which might take over both the failed banks and their bad debts, or on depositors who end up paying for the bad debts. Do you think it's preferable for such situations to occur frequently or infrequently? This creates a tough choice. If the central bank supports small banks, government bond yield will likely continue to fall. Conversely, if the central bank raises bond yields, it risks causing the collapse of these small banks. How do you think this situation will evolve? I believe the scenario will unfold like this. The central bank will impose penalties on these small banks and temporarily freeze their accounts, but eventually it will quietly lift the freeze. The central bank will avoid letting these banks go bankrupt too quickly, allowing them to resume trading government bonds after some time. These actions will be carried out discreetly. Publicly, the central banks will appear to be rigorously enforcing regulations and imposing severe penalties, conducting thorough investigations into not just the 4 banks, but others as well. This is meant to signal to the market that the central bank is taking drastic measures. Be aware. Consequently, the most aggressive bond speculators will be the first to exit, which is precisely what the central bank is aiming for. In addition to managing banks, the central bank also needs to tackle bond funds. Its primary strategy is to slow down the approval process through the China Securities Regulatory Commission. By delaying approvals, the central bank aims to make operations for bond funds difficult. The second strategy is to limit the investment duration of bond funds. What does this entail? Simply put, a longer investment duration allows bond funds to seek higher returns, albeit with increased risk. However, if the investment duration is restricted to a very short period like the current regulatory limit of 2 years, then the bond fund's return will be modest and the risks minimal, leading to uninspiring results. At first glance, you might think that the regulators are just helping to reduce risk by promoting lower risk bond funds. Isn't it better to invest in a fund with lower risks? However, that's not entirely accurate. Here's why. In the government bond market, the strategy for making profits is quite clear. Over the long term, government bond yields are expected to fall. The longer the duration of a bond, the more sensitive its price is to changes in interest rates. This means that if the central bank cuts rates, the price of longer duration bonds will increase significantly, leading to higher returns. So in this scenario, investing in government bonds with a longer duration is actually more advantageous. The restriction that bond funds cannot have an investment duration longer than 2 years effectively caps their potential returns. When bond funds are unable to offer attractive returns, they fail to attract more investments. Consequently, ordinary investors in these funds end up with minimal gains. Our analysis suggests that the Communist Party's actions are designed to prevent ordinary Chinese people from improving their lives. With few investment options available, people turn to bonds for modest returns. However, the party restricts the potential earnings of bond funds, effectively hindering people from making money. This policy appears to be more about preserving the Emperor Xi's public image than about enhancing the financial well-being of the general public. Now, with the likelihood of US rate cuts becoming more apparent and the US dollar index falling, the renminbi exchange rate has recently improved to around 7.17 to 7.18. From our observations over the past 2 years, it's clear that the central bank's exchange rate floor is approximately 7.3. This means there is considerable room for the central bank to lower interest rates. There is a growing consensus that the central bank should cut interest rates again. Currently, the 1-year LPR stands at 3.35% and the 5-year LPR at 3.85%. In my opinion, the one-year LPR should be reduced to below 3% in one go, providing a substantial boost to the economy and helping to achieve the 5% GDP growth target for the second half of the year. A rate cut can be quite effective. Unlike direct money printing, lowering interest rates alleviate the debt burden for borrowers, essentially putting more money into circulation. This has its benefits, though it comes at the expense of bank profits. Given that the banks are already struggling and relying on government bonds trading for income, a further rate cut could force them to reduce interest rates on demand deposits to near zero and cut 5-year fixed deposit rates to around 1%. As a result, people might rush to withdraw their savings from banks to invest in government bonds. This would increase demand for bonds, pushing bond yields even lower. If the central bank fails to meet its economic targets, it could face repercussions from Emperor Xi. So where does the problem lie? It's clear that the issue stems from Xi Jinping. The choice is now between preserving Xi's image and achieving the GDP growth target. It's impossible to do both. The question is, which will Xi prioritize? If he chooses to prioritize his image, the central bank might close a few more accounts of institutions involved in trading government bonds, effectively eliminating some of the bullish positions. This would lead to a rise in bond yields. On the other hand, if Xi Jinping decides to focus on GDP growth, he will have to accept the current reality of declining bond yields. I would recommend that Xi apply a bit of the self-victory spirit and look at Japan's example. Japan has had zero or even negative bond yields for years, which puts China's situation in a better light. So the central bank should continue with rate cuts and monetary easing as necessary. With bond yields not yet at zero, Xi can maintain a positive narrative about the Chinese economy, keeping the situation under control and stifling any dissent. How nice! Thank you so much for watching. If you find this video helpful, please like it, drop a comment below, and hit the subscribe button right here. It really helps YouTube suggest my video to others. I'll be back with more content soon. Until then, stay well.